Hi, it's Griggs with Obsidian Wisdom. Today we answer the question, how do I invest in the stock market to build wealth? Today I'm going to give you 10 strategies that you can use today to increase the likelihood of you being able to achieve your wealthy retirement so that you have the lifestyle you want without having to worry about running out of money and at the same time building generational wealth and a lasting legacy. So, when it comes to investing in the stock market for wealth, let's start with why it's a great idea. So, first and foremost, did you know the top 10% of wealth in the United States owns 89% of the stock market? You heard me right. The top 10% of wealth in the United States invest in the stock market and own 89% of the stock market, which naturally brings the question, well, what does the bottom 50% own? And if you guess less than 1%, 0.6% to be exact, you would be correct. So, what does that tell us? You guys know I'm big on ratios. If I told you that the top 10% of wealth in the United States owns 89% of the stock market, wouldn't that lend you to believe that the stock market must be a great place to put your money? When you look at some of the wealthiest people in the country, you find that they are investors. Sure, some of them are hedge fund investors, some of them are mutual fund investors. You know Warren Buffett, you know Bill Ackerman. There's so many high profile names, even the likes of well known investor who had just bought the Washington Commanders. You find that investing in the stock market seems to be a great strategy for many people. But yet, why do so many people not invest in the stock market? And I will tell you that the number one reason people don't invest in the stock market is because they lost their money at some point in time. It is true that the stock market is volatile, which is a very fancy way of saying that there are some days that you're winning and there are some days that you're losing. And as a result, the average investor, what they'll do is when everyone is saying this is the best stock ever. So let's do like a meme stock like GameStop. This is the best stock ever, or Robinhood. This is the best stock ever. Or they'll say, oh, marijuana is going to be legal. Buy marijuana stocks. Oh, the AI revolution is going to be the best thing ever. Go ahead and buy every AI stock that you can get. Or the metaverse. And they'll say, buy all the metaverse because everybody's going to have these VR headsets and we're not going to meet in person anymore. And it's a well known rule that if it's on the news, that means you should probably sell it, right? There are funds out there that basically will say, I'll find the stock when nobody knows about it. I'll buy it then. And then as they increase in value, they'll eventually get so much notoriety that we'll see them on the news. And when they're on the news, that's when all the bandwagoners are going to jump in. And that's when professionals sell their stocks. Because as you heard Warren Buffett say, you want to be greedy when people are fearful, and you want to be fearful when people are greedy. And that leads us nicely into number one on our list, which is you got to educate yourself on the basics of investing. And that includes things like asset classes and risk. And we'll go into risk a little bit more later. But did you know there was a study? It's called the Brinson study. And what they did is they looked at a variety of portfolios and they found the number one indicator of whether the stock performed very well or whether it did not perform very well was asset allocation. 90% of the portfolio's return was driven by asset allocation. They found that timing the market or selecting stocks or mutual funds that only accounted for about 6.5% of the portfolio's return. So when you look at creating wealth through the stock market, you have to learn how to create a portfolio. And that leads very nicely into number two on our list. For you to create a successful investment portfolio, you have to know two things. One is you have to know your overall time horizon. How long am I going to leave this money invested in the stock market? And two, you have to know your risk tolerance. There are certain asset classes that are very volatile where the market goes up and the market goes down. And for some people, that may be difficult for them to stomach, where they can leave their money in and follow the strategy that they have set if they see the market is going up 10% and down 15%. Some high volatility stocks may include international stocks, stocks in emerging markets, where there's so much uncertainty, so much that we don't know about other countries, the way that they operate, whether their numbers are good, how they run those companies, whether it's a safe environment as far as the government supporting the business or is the government like stealing from the business. There's so much information that we don't know to be able to make a solid investment decision that's why emerging markets tend to be very difficult. If you're someone who's more comfortable with real estate, you may have REITs, real estate investment trusts, where you can buy stocks and companies that have a real estate portfolio and you're able to take advantage of some of those rental returns through your investments in the stock market. There is so much that goes into creating your overall portfolio, but it really comes down to knowing how long you have to be in the market. I tell most people, if you're going to invest in the stock market, you got to give me at least 5 years because we don't know if the next 5 years is going to be spectacular. We don't know whether there's going to be like a crazy election swing or there's going to be a war that happens in a country or something like that. But we do need a little bit of time to be able to adjust for that, where we may lose 5 or 10% because something happened. But if we can stay invested for the full 5 years, we normally make that back and then some. But that's only an option when we have a long term strategy in place. That's why for most people, you can't be invested for 5 years. You'd probably be better off investing in investment grade bonds, maybe some treasuries, where you have a shorter time horizon and there's not as much volatility. Now, granted, if you have a portfolio built like that, it's going to be more conservative. So you're generally not going to make as much, but you probably can still keep up with inflation, which is at the minimum what we're looking for. Now, most people, what they do is they have the opposite mindset where they said, I need a whole bunch of money in a short amount of time. So where is the home run I can swing for? And unfortunately, that is what lends us to being taken advantage of in scams. You're not going to find a professional who's going to say, yeah, for sure, let's go invest in Bitcoin because we can make 1,000% every single week. And then you'll have all the money you need to pay off all your bills in 12 months. That's not very realistic. But unfortunately, because there's so many people who have no idea what they're talking about, and that's the majority of the information that you hear, which is half the reason I make these videos, because I'm trying to help you guys get a little bit of information where you have some realistic numbers and some expectations. Because if you train yourself with these false narratives, then when I offer you reality, you're going to say, no, Dre, I know somebody that can get me 10% every single week. Then I'm going to say, I don't believe it, but you believe it because you keep seeing and hearing it. I would equate it to my girls watching a Minecraft YouTube channel, right? They watch the videos and there's these people, I forget their names, but they literally have millions of people watch the video, which blows my mind. But what ultimately is happening is my girls are like, okay, I've been watching Minecraft all the time. Can I download Minecraft so I can play too? Right, like, that's just a natural cause of us watching and absorbing certain information. They wanna play too. It seems like a lot of fun. I wanna play. I've been imagining myself playing the game from watching other people play it. And if you don't think that that's true for adults, I would encourage you to go ahead and Google the military and how they work with, like, Call of Duty and some of these other games, because they know that if people play these video games, they're more likely to wanna join the military. There is so much that you have to be able to shield your mind from. Otherwise, you'll be training yourself to seek scams and you'll be rejecting legitimate opportunities because you believe that the scams is actually the base of reality. And it's really unfortunate. So I do encourage you guys to make sure that you have that base of knowledge when it comes to investing. And this is number 3 on our list. What are your goals? If you're able to achieve your goals with a 5% return, then we should put a portfolio together to achieve a 5% return. There's no reason for us to swing for the fences if you can achieve your goals with a 5% return. Now, at the same time, if you're someone that needs an 8 to 10% return, and that's about the average of the stock market, then we can put a portfolio together that would allow you to achieve that goal. If you're someone that needs a 15% return, well, now we're talking a little bit different because that number is not aligned with what you traditionally should expect in the stock market. Is it possible that we can put a portfolio together to get you that 15% return to achieve your goals? It's possible, but it's also possible that that same portfolio could lose 20% in a particular year, and then it could gain 30% the next year. Like, we don't really know how it's going to average that 15. And because your overall risk tolerance, you want to be very mindful about the volatility. What is the highest that that portfolio can achieve? And what is the lowest that that portfolio can achieve? Now, there's people that will come up and ask me, and they'll say, Dre, I saw that you can invest just in Tesla and you can retire off a Tesla because it's projected to have a 10, 20, 30% growth over the next 10 years. And as a result, if I put all my money in Tesla, I'll get this compounding interest and I'll be a millionaire, which is true. Like, if that actually happens. But you and I both know projections don't always match reality. Sure, Tesla right now has an advantage in the electric vehicle market, but do we know that everybody's really going to keep going to electric vehicles? Do we know that the market is going to be sustainable? Do we know that there won't be someone who comes up with a new innovation that completely revolutionizes electric vehicles and they take everything over? There's so much that we don't know that it's very hard to just put your money in one company. Now, you could, but that does open you up to what is called business risk, which is a very fancy way of saying that there's a business and I'm investing in that business. And if that business fails, if the management team changes, the leadership goes in the wrong direction, or there's just something that causes the company to skip a step, I am all in with them. So I win or I lose with them. If the company is completely gone, then all of my money is completely gone with the company. I haven't hedged my risk in any way. And so if you're okay taking on that risk, then you can do that. But generally, I would say you don't want to do that. For most people, you don't have a risk tolerance that is A, 100% invested in the stock market, and B, 100% invested in one company. That is such a significant amount of risk that the average person actually would not be able to do that. Now, you may say, well, Dre, this is my like slush fund, right? Like, so instead of me going golfing or going to casino, I have this 5% of my portfolio that I'm going to invest for home run. You already know I'm okay with that. If it's the equivalent of a vacation fund, then you guys already know I'm like, go for it. Because if we lose it all, it doesn't matter because that's not what we're building our retirement fund off of. The problem is the majority of people I talk to, they are literally building all of their wealth off of this one idea. And that I can't co-sign with. Number 4 on the list is you need to invest consistently. There are so many studies about timing the market or spending time in the market, and spending time in the market wins all the time. And the reason is very simple. If you take the returns over the last 20, 30 years, or any sort of a period like that, if you took your money out when the market was at its lowest, you'll find that the market had a significant amount of growth in that window also. And the studies will show that if you miss like the best 5 days, then you may lose 5% of your return. So if the average stock market return was 8%, you may only have 3%. If you miss the best 30 days over a span of 20 years now, where you just missed a month over 20 years, you find that your portfolio is probably going to be breaking even at a 0% return or really close to negative. And that is the reason that the average person can't be timing the market. Sure, there's people out there that will tell you day trading is super easy and that they do it all the time and that they're crushing it. But when you actually look at what they're doing, for the most part, they're day trading against their own advice, where they'll say, this is the best stock, everybody go in it. And then when people listen to them, that creates the little swing that they then sell off of and make their returns. So for the most part, when it comes to you building wealth, you don't want to have such a conflict of interest with the person giving you advice where they make money when you lose money. Ideally, it would be better if your advisor makes money when you make money as well. Another one of the benefits of consistently investing is compounding interest. There's an interesting quote by Albert Einstein, and he says, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. As difficult as it is to pay off a credit card if you're only making the minimum payment because of compounding interest and how it's eating up your money when you make the payment, it's the opposite when it comes to building your wealth. No matter how much little you put in, if that amount is compounding over time, it continues to grow and the snowball grows and grows, which is why building the habit of investing in yourself, paying yourself first for your money is a fantastic habit to have. Number 5 is you want to develop a long-term investment strategy so you can cut out the emotional reactions to fluctuations. The beauty of having a long-term investment strategy where you have a portfolio that you maintain is every time you buy and sell, it's based off of your portfolio allocation. If my portfolio is supposed to be 50% stocks and 50% bonds, and for whatever reason, the stock market is going gangbusters, so now my portfolio has 70% stocks, and because bonds aren't doing well, where they keep losing money every time I put money in, now they're down to 30% of my portfolio. Well, my portfolio is supposed to be 50% stocks and 50% bonds. So I have to bring my portfolio back into balance. And the way I do that is I sell for my 70% stocks, which is you selling high, right? Because this stock is going up. Every time I buy it, it just goes up another 10%. So now I'm required to sell 20% of my portfolio at its highest, which is selling high, which is what all of us want to do. And then because 50% of my portfolio is supposed to be in bonds and it's now down to 30%, I buy 20% more in the bonds to bring my portfolio back to 50% stocks and 50% bonds. That is what we call removing the emotion from investing. Otherwise, what you'll do is you will put your $100 in bonds, let's say, and then every time you put $100 in bonds, it loses 30%. And you're like, what am I doing here? Now, granted, obviously, that would be very unlikely to lose 30% in bonds, but you get the example. So the average person is saying, okay, I put $100 in bonds and that's going down. I put $100 in the stock market and that's going up 10% every single time. I'm going to put $200 in the stock market and I'll put nothing in the bonds because I don't like the feeling of losing money. That is what the average investor does. That is what we call emotional investing. So what you end up doing is you're now buying high. And realistically, we talked about the volatility where if there is a year where you have 20% gains and the average is 10%, it's highly likely that the next year you're probably going to have a 10% loss. And I can show you charts where it shows us by sectors, where you can see that the stock that had the best year or the one year is probably going to have a not so great year the next year, because that's what makes an average return. You can't always have a 20, 30% return inside of your certain portfolio. And as a result, if you end up doing that, you're basically setting yourself up for failure. You are now buying more of the stocks at the highest point, and they're probably going to drop down. As long as you have a disciplined strategy where I invest the same amount every single month, every single paycheck, and then I buy the same portfolio allocation. Now, granted, you may have to adjust your portfolio allocation maybe every 5 or 10 years, depending on how close you are to your retirement. So you just want to be able to shift your portfolio to where you're able to maintain and start preserving some of your wealth. But all of that requires you to have a disciplined investment strategy that you will stick to regardless of what's happening around you. Otherwise, you're going to be watching the tickers, watching the news programs, and they're going to be screaming bloody murder, making it seem like everything's going bad. And you're going to be freaked out and you're going to make a bad emotional investment decision, which is not going to be in your best interest when it comes to long-term investment success. That leads us nicely in number 6, which is you got to rebalance your portfolio periodically. Now, we talked about the overall idea of maintaining a certain allocation, but you would say, all right, well, when do I make that adjustment, Dre? And for most people, they would say at the lowest, you should probably readjust it every year. You don't want to do it every single month because if you're selling and buying in stocks on a high frequency, then you end up increasing your overall investment cost. And we'll go into that with step 9. But the goal is to build a portfolio that allows us to keep our money invested for at least a year and a day so that we can have a more favorable tax treatment. Then, when you look at your overall brokerage accounts, where there's certain investments that you do, where there's a certain fee associated with each one, it's part of the reason why day trading doesn't generally work out because when you include the fees and the taxes of the day trade, it just normally doesn't mathematically work out for most people because there are fees to execute the trades that most brokerages will charge. So in the low end, we'd rebalance our portfolio every single year, where every single year around the same month, we'll just look at our portfolio and we'll see how we're doing. And then we'll make the adjustments where if I'm out of whack, where I have too much of one stock or too little of another stock, I will buy and sell to bring myself back to balance. For most people, it normally makes sense to be more like every 2 years. That gives you a little bit of a chance to kind of ride some of that growth where, sure, we want to make sure that we have a disciplined approach where we're selling at the highest point so we make a nice profit. But at the same time, you may be limiting some of the overall gains that you could have, which is why a lot of people like to rebalance the portfolio every 2 years. I know some that do it every 3 years. I wouldn't say going higher than 3 years would make sense. If you're not rebalancing your portfolio every 3 years, there could be significant market swings that you may be caught out of balance where you may be more aggressive than you wanted to be. And as a result, you can end up losing a significant amount of money. Now, granted, you also could be more conservative than you wanted to be just because of the way the market was flowing. And then you may be missing out on a significant growth opportunity. So it's normally good to rebalance at a maximum every 3 years, but probably at a minimum every 1 year. And I would even consider doing it every 2 years. I really like 2 years, but that really does depend on you and your own personal investment strategy and your overall risk tolerance. First off, let me just thank you for watching this video up until this point. You could be anywhere and you chose to be here with me. If you find value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insight on how to solve generational wealth through strategic retirement planning. Number 7 on our list is you want to consider dollar cost averaging when it comes to investing. So again, I'm big on building solid investment habits, and investing in the stock market on a regular cadence, on a regular frequency is a good thing. You could take a large lump sum of money and put in the stock market, and you may have picked the exact perfect time where the stocks you pick just skyrocket and you make a 20% return in the first month and you're like, yes, I got this. I figured it all out. But it's also possible that you invested at the worst time. And we call this sequence of returns, which is a very fancy way of saying that if you lose money in the first year of your portfolio investment, it is a big hole that you have to climb out of, and it could significantly alter the amount of money that you would have. And the way you would think about it is, let's say you invested $1,000 and you lost 10% of your portfolio. You couldn't just go out and make 10% the next year and be back to even. You'd actually need to make slightly more than 10%. Right? The idea of compounding interest is now working against you, where it's negatively compounding. And as a result, you may end up having to get 10% 1 year and you may have to get like 8% the next year just to get back to even. But in the same situation, if you started off with 10% and then you got the 8%, now your portfolio is much higher. And then you lost that same 10% that the person lost in their first year, but maybe you lost it on your 8th year. Because you're so much higher, you're not even in the hole. You've already compounded so much higher that 8% loss doesn't really impact your portfolio the same way. That's what we call a sequence of returns. And I know they use very fancy words all the time, and I don't know why, but it's just the sequence of events, right? The order that I have my gains and losses significantly impacts my portfolio. To limit that, that is why we normally tell people to use dollar cost averaging. If I put the same amount of money in every single month, there's going to be some months where the stock was very high. There's going to be some months where the stock was very low. But because I just consistently invested, the average that I got for the year is a much safer number than me hoping that I picked the exact right month. And that's why for some people, even if they have a large lump sum of money, let's say you were a teacher and you were in the drop program and you got like $100,000, you would generally not just buy $100,000 worth of stock because we don't know what's been going on at that particular point in time. We would normally make small investments over a period of time so that way we can average a nice portfolio. Now, it'd be fair to say that there are times where obviously it works out for you, where you invest in the stock and it goes up and you get to ride all of those gains right out the gate. This is simply a hedge against the possibility of you buying the stock and it dropping 20% the day after you bought $100,000 worth of stocks. Just a hedge. It's not always that way. but I find it to be a safer approach, especially if you have a long-term investment philosophy. Number 8 is you want to stay informed about economic and market trends. The way how we think about this is imagine the news, right? So you can watch the news every single night. You can watch the news all day. That there's news on every single day, all day. But do you really have to watch it? Is there that much going on in the world? You may say, of course it's Ray. I need to know everything. I would say probably not. You can easily watch a Sunday show that gives you a recap for the whole week, and you can watch that for an hour or 2 hours, and you can have the same understanding. And sure, you could say, well, you didn't have it the same day that I got it. Well, that's true. But what did you do with the information with that extra like day that you had, right? Like realistically, that's about the way I feel with economic trends, except I would even extend it out a month. I think you can check in on the economic trends once a month and be fine. Just check in once a month, maybe with a jobs report, and just see what the Fed says, see what the unemployment rate is, see what the consumer sentiment is, right? How do people feel about the overall economy? Do they feel good about it? See what some of the analysts are saying. And you can probably do that once a month, and you can have a really good feel for the overall economy. There are so many amazing reports that are put out there on a regular basis where they give the information of how this impacts everybody globally. You can read how does the war in Ukraine, what does that impact? And you can read about how it impacts the grain market or the energy market with Russian oil, or you can read about China and Taiwan and semiconductors and whether that makes sense or whether it's going to blow up in our face. The information is there, but you don't have to track it every single day, right? Like you can have a regular life. You're not day trading. You're not trying to time the market. You simply want to have a general understanding. Is there some information out there that I should be aware of? Is there a significant event that I should be looking at? Now, for some of you who are even following once a month is too much, if you choose a portfolio that is designed to do well in a variety of markets, and so there's different ones. I think Ray Dalio has the all season portfolio. The permanent portfolio also comes to mind. I think the golden butterfly portfolio comes to mind. These are portfolios that are designed where a portion of the portfolio does well in every single market, and a portion of the portfolio doesn't do that great in every single market. But you're hedged in a way that it protects you from whatever the market is going to do. And that way you don't have to follow the news. And some people will do that as well. And that works for them. Number 9 is you want to use tax efficient investment strategies just to limit some of your liabilities. Most of us don't want to be paying a bunch of taxes, so you got to keep track of Uncle Sam and the money that he's going to take. Uncle Sam incentivizes you to be a long term investor, so that is capital gains, is what we call it. And the way that you access capital gains is by having your money invested for a year and a day. If you leave it in there for a year and a day, that is not considered ordinary income. If you are a short term trader, then that's considered ordinary income and you'll be taxed on whatever your normal tax rate is. If you want to be able to limit the taxes, then you'll take advantage of being invested as a long-term investor, which I generally recommend anyways. You also want to keep in mind some of those employer-sponsored plans, where if you touch the money before 59 and a half, you wouldn't only be paying your ordinary tax rate, but you'd probably also be paying a penalty. So when it comes to accessing your money and the way that you invest, if you're someone who's putting money away where you want to retire in like your 50s, and you're saying, Dre, I won't be able to touch any of my money because it's all inside of my employer-sponsored plan, which is like your 401k, 403b, or pension, something like that, well, then you should have a portion of your money that is invested in after tax investments that you could access without having any sort of a penalty. Now, another tax efficient strategy may be taking advantage of a Roth conversion. Now, this works for a lot of people. The idea is if I retired at like 64, but I'm not taking Social Security or my only income is for my investment, generally you're going to be in a much lower tax bracket than the years that you're making in income. As a result, it may make sense for you to go ahead and take some of your pre-tax investments, like the 401k and 403b, and you start converting those into a Roth. Now, when you convert something into Roth, you got to pay the taxes on the event, right? Because it went from pre-tax to after tax. But because your income is so limited, you may actually still be in one of the lowest tax brackets where instead of you waiting till the end where you have all of your income coming from your investments and you may be in a higher tax bracket, by getting rid of some of those pre-tax investments and go ahead and paying the tax in your lower income years, sometimes you're able to give yourself a significant amount of tax-free income at the end because you've been converting it to tax-free, paying each year that you don't have a significant amount of income, the taxes, so that way you're able to do those conversions. Now, for many people, when it comes to creating a tax-efficient withdrawal, most people will say, take your pre-tax assets first, so the money that hasn't been taxed yet, but has been sitting in a pre-tax account, go ahead and get that out of the way. Hopefully, you're not going to have as much income, so the taxes are lower. Then, second, you normally take your after tax assets, the money in your brokerage account, and things like that, go ahead and pay the capital gains on that. And then the last thing that you'll take is normally your tax free money. And that normally works for most people because it gives your tax free money the most amount of time to continue growing. And you may find yourself in the last 10, 15 years of your retirement where all of your income is tax free because you've gotten rid of your pre tax income and you got rid of your capital gains income. And now all you have left is your overall tax free income. And the 10th and final tip I have for you is you may want to seek professional advice. And the reason I say that, you guys know I'm big on wisdom and experience, right? Wisdom is experience. The reason that King Solomon did such a great job is because he gained the wisdom of a king that had been there for 50, 100 years. And if you have the wisdom, we talk about that all the time, where if I can go back, I would do things so differently. Well, what's changed? Well, your awareness and the wisdom and your understanding, your overall experiences have changed your perception, and you would do things differently if you can go back. And that's why wisdom is so important, which is generally why I tell people, look, if you are trying this out for the first time and you're not 100% sure, even if you just wanted a second opinion, I would say go talk to a professional. Now, granted, all professionals aren't created equal. You may not get your money's worth with certain professionals, but if you find one that does provide you the value, imagine the wisdom that they have from all of the plans they put together, all of their clients and the experiences that they've gone through, where you're able to say, well, there was this one client that did this amazing thing and it worked really well for them. Or we tried this with this one client and it didn't work because of this particular situation. As a result, it opens you up. It gives you more awareness. Even if you decide not to enact the plans or work with that advisor, you may just be able to gain some of their wisdom and experience to help you craft your own perfect plan. Because all financial planners aren't created equal, it's normally great to start with a fiduciary. Make sure that this person has your interests first. Make sure you have the recourse available where the person messes you over, that you can file a complaint, that you can have possibly some way to get your money back. And as I mentioned earlier, you want to make sure that your income is aligned. And that's normally why I tell people to lean towards a fee only planner, because they make money when you make money. You're tied together. When you have a commission based planner, even though they may be a fiduciary, there are certain percentages that they get based off of the different investments that they offer. And if they're offered a 50% commission over here and a 5% commission over here, or even the products that they're offered, where you think of some of these places almost like a casino, the dealer is impartial. They just give you the cards, but the way the game was designed by the casino, it already tilts it in the house's favor. And I find that a lot of commission financial planners who have the best intentions in mind, because the casino designed the products that you're being offered, they've already tilted it in their favor just by you choosing the product. So normally I tell people, when you're looking for a professional, those are the two things that I normally look for. Sure, you can get into experience, you can get into education, you can get into vibe and how you feel with them, but it's normally a good place to start with a fee only fiduciary financial planner.